So let's kick off with the kick off where we left off with the questions there. So let's start with a bit of history in terms of what role did accounting play in the crisis. We saw quite a few people there arguing, saying clearly in the audience you feel it played rather a large role. Perhaps Mike, as a former auditor and now on an audit committee, an exec director back, what do you think?
I suppose I would be in the field of minor role rather than major role. So I'm still with a large proportion of the audience, because I think it was 23 before it dropped off. I think the main cause of the financial crisis, frankly, at the end of the day, was a lack of capital within the financial system. You can argue to what extent that was caused by the accounting model. I'm not sure it was. I think it was caused by a lot of regulatory models that took a great deal of account of what you might expect to do to hit sort of 95% confidence and ignored what happened at the tail, and particularly when you had concentrations of risk. And perversely, securitizations, as opposed to diversifying it all, which everyone thought actually concentrated it in many ways. So you had, when things went bad, everyone caught a cold rather than just a few people. So I don't think, I was interested, you said accounting. You didn't say IFRS, you said accounting. So for example, if you look at the various aspects of accounting, I would have said that in terms of off-balance sheet securitization, I think the IFRS model was not too bad. I think the US GAAP model, which is actually where a lot of the securitizations emanated from, was not good. So if you wanted me to, that would tip me into the minor role as opposed to no significant role point, because I do think that actually the securitization model in the US allowed a lot of things to be done, which people did in a US environment that they then exported to the rest of the world.
So Wynne, you've been chairman of Citigroup and Lloyds, two banks that were right at the heart of the financial crisis. What role do you think accounting played in the problems at those two institutions?
I think obviously accounting, in my view, did play a role. I would say it's a minor role. If I look back on it, I think we have to acknowledge that management and governance played the major role. I mean, I think if you ask this audience, and if you asked people who were in fact involved in the management of banks at that particular time, I think the management side is a much greater. There are, because it's very interesting, there are banks that survive quite well despite using the same accounting principles and so on. So I think management, governance played the major role. There was of course a minor role, but I think I believe very strongly that whatever, in fact, the shortcomings may have been in relation to certain standards, and I tend to think one in particular, obviously expected loss, or the non-usage of expected loss, ultimately it comes down to the judgment and the governance of banking institutions.
Hugh, would you agree with that? Do you think the auditors perhaps, therefore, in terms of had an important governance role in terms of the accounting? And as Wynne said, some banks using the same accounting had problems and some didn't. Do you think that perhaps it was the auditors?
I think auditors have an interesting part here, because I think there is a significant expectations gap in terms of what auditors by law are required to do versus what the outside world might perceive them to do. To me, if you think about the crisis, I remember reading at the time a book by J.K. Galbraith on speculative bubbles, and from time to time, speculative behaviour takes over. It took over partly in the housing market, partly in the banking world, and I guess you had two big speculative bubbles coinciding. So to me, fundamentally, it was a human behavioural thing which repeats itself through history. And I think accounting is a language which describes what is going on in the real world. I think in this case, it was helpful for bringing some of the bad news into the open quite quickly. And we didn't suffer from, Japan suffered a whole lost decade because of, to some extent, or in part because of a lack of transparency. And I think the auditors were, I find it very difficult to ascribe to auditors a very key role. I think one has to start with the transactions, whether they're in the housing market or in the banks, and one works from there. I do think, though, there is a significant expectations gap, as I said at the start, between what auditors are required by law to do and what is sometimes perceived.
Sue, do you want to take up Mike's point that this distinction between, I framed the question as accounting, but and Mike talked about the IFRS. I mean, having come through this process and been involved with the IFRS for a long time, what's your view on the role of, or whether IFRS stood up well in the crisis?
I certainly don't think that accounting, IFRS or US GAAP, caused the crisis. I think what it did show was where we could make improvements in accounting standards, and I'd agree with Mike that I think that our off-balance sheet standards stood up pretty well in the crisis. The only change we decided we really needed to make from the lessons learned, if you like, was to enhance disclosures about off-balance sheet transactions where they were not consolidated. Obviously, another consequence has been to improve the forward-looking nature of the impairment model. But I think that the important lesson I think we should all take away from that, as well as in terms of our expectations management for the future. Because even though we've moved to a more forward-looking expected credit loss model, which was in response to the lack of timeliness of recognition of changes in credit expectations during the crisis of the incurred loss model that we had both under IFRS and under US GAAP, our expert advisory panel that worked with us in developing our impairment requirements reminded us repeatedly that even if we'd had an expected credit loss model in place before the crisis hit, or as the crisis hit, it wouldn't have predicted the crisis, because those were unexpected losses. They weren't expected credit losses. The market wasn't expecting those to hit. And so while we hope that our new model will be more timely once people realise things are turning in the wrong direction, it would still not preempt or forward look what the market's expectations are, because by definition they're not expectations.
Vincent, so we've heard from other people on the panel who represent the corporate interest, the accounting industry interest, and the IFRS. Half the audience here thinks accounting played a major role. You as the CFA Institute, represent the investor interest. What do you think of the role that accounting played in the crisis?
I'd also be in the camp of it playing a minor role. So it's insignificant relative to other factors. I think the panel has mentioned the corporate governance factors, the loan origination that was in place, but also there'd be the macroeconomic factors which led to a glut of liquidity, which then incentivized what tended to be a tendency to take more risk than should have been the case. But the point I'd just like to mention would be around, just to pinpoint where accounting would have had a role, would be around when you look at the price-to-book ratios of banks, and you look at the trend since the beginning of the crisis, where there's been a significant decline in the price-to-book ratios of banks. That in itself is indicative of investors having had some valuation uncertainty with bank balance sheets. Also, when you look at the CDS spreads of banking financial institutions, and when you compare them with similar, like when you look at investment grade, for example, banking institutions, and compare them with non-financial companies, there was clearly an indication of risk aversion towards the bank financial institutions. That in itself points to investors having been surprised to a certain extent by the state of risk of the banking financial institutions. And accounting would obviously have had a role in that respect. And I think the panel has pointed out to the different areas which would have been of concern to investors as well. So the loan impairment approach, the provisioning that was in place. Mike mentioned the securitization. That was clearly a factor, though it was a bigger play under US GAAP relative to IFRS. I'd also mention when you look at CDS contracts and the exposures that different financial institutions had as counterparties, accounting could have done a better job in communicating the risk exposures. So in sum, I would mention that there are certainly issues around how financial instruments are measured and represented on the financial statements. And then there'd also be the question of the completeness in the communication of risk exposures. And clearly, as Sue has been pointed, this was an opportunity to look at those deficiencies and augment those areas within the accounting standards, But I'd also like to mention that it's gone beyond what's being done by the accounting standards. So for example, the Financial Stability Board Enhanced Disclosure Task Force did identify areas that could be done to improve risk reporting, and that certainly has been helpful for investors.
Well, you nicely line up there the next question I wanted to come on to, this question of the reforms of the fair value of financial instruments. So Vincent makes an interesting point, an important point there, isn't it, which is that that the market, in a sense, gave its own verdict on accounting standards during the crisis by the very low price-to-book ratios that banks traded at, and arguably at least part of that was a reflection of uncertainty about the value of balance sheets. Do you think that that the changes in the on fair value of financial instruments do you think they've been a positive step to providing more useful information for investors, or have made the situation more opaque?
Well, I think at the moment, when one looks at the valuation of banks, I would suggest that it hasn't yet made very much of a difference. I think there are banks which are valued at well above book, price to book, in the market, and there are those that are valued quite a way below. And I think that probably has in the investors' minds, I'll be interested to hear, investors' minds, something to do with the opaqueness and the difficulty of modeling. For example, Wells Fargo and Lloyd's are trading at well above book value. It's a relatively easy model. They may go wrong. It's a relatively easy model for the analyst to look at. It's retail, there's an annuity element, et cetera, whereas somebody like Deutsche Bank, which is an outstanding bank in my view, is trading at something like 0.6 to 0.7, and you have a range in between there. So the complexity which I think investors assign to certain types of institutions is reflected in the price, and it isn't just therefore an accounting. It's how do you get an accounting standard and the way that perhaps there is a greater certainty. How do you get that across to investors, and how can investors in fact be encouraged to model that in some way? And the investors or the analysts looking at it at the moment are still saying it's still very complex.
Sue, well, from the IASB side, do you want to what the investors saying it's still very complex? What's your response to that?
There's only so much accounting can do when you're accounting for complex businesses and complex financial instruments, I think. But we hope that with IFRS 9, and of course we haven't seen it applied yet, so it's hard to sort of preempt or predict what the effect is, but we hope with IFRS 9, where we've been very careful to try and make sure that fair value is used where it is the most useful information in terms of recognition and measurement, so based on whether you're holding assets just to collect cash flows or trading, and how complex the cash flows on the instrument are to decide how things should be measured. But I think even with IFRS 9, in terms of fair value, we would still expect a large portion of banks' balance sheets to be measured at amortised cost with the benefit of the new expected credit loss model, assuming that their financial assets are as simple as we hope they are in their simple banking books. So it's not as though we're sort of suddenly hugely increasing the use of fair value measurement, at least not intentionally, in IFRS 9. It's rather being careful about when it's used and when it provides the most relevant information to users of financial statements, and we hope we've got that right.
Yes. Mike, you used to work for Barclays, which is famous for the simplicity of its financial instruments. Do you feel that what do you have to say on this?
I wanted to make a very specific point, actually, which is if you look at the level 3 financial instrument disclosures, so those instruments where there's at least one unobservable input, and then you look at the sensitivity analyses around those level 3 financial instruments, you will find for any bank which has got very significant investment banking activity that the numbers are really very, very large indeed, and often a very sizable proportion of the capital base, and even significant compared to the market capitalisation of these banks. So I guess in response, what is accounting doing? I think if you home in on those disclosures, you can see that the accounting is telling you there are some significant uncertainties, and that's one of the reasons why you get these funny price-to-book values, ratios.
Mike, you're more recent. You joined to Barclays and have been brought in part to cast a fresh eye on Barclays accounting, where there were some issues during the crisis with accounting at Barclays. Do you think that, and of course Barclays board has put the tender for the audit out put the audit out for tender for the first time in 150 odd years. So do you think that that there's potential for provide more useful information in the Barclays accounts? Do you think that that IFRS 9 is a step forward for Barclays in terms of its transparency?
I think every little helps, but I come back to the point, I'm not sure accounting played the major role in the financial crisis. And I think it's got to be accepted that when you're looking at book-to-market ratios, for example, a lot of that, as Vincent said, is reflecting uncertainty, and that's uncertainty about the future. And accounting is, to many points of view, actually describing where we are today. It's not there to forecast future macroeconomic events which haven't yet occurred, or regulatory interventions that are still in the pipeline. And there's a lot of uncertainty, and the more complex the business, actually, the more uncertainty there tends to be. So it doesn't surprise me that you've still got that anomaly now. I don't think it's anything to do fundamentally with the accounting. I mean, it's interesting about what you say about disclosure, because just picking up Hugh's point on level 3, if you read Barclays accounts, you'll see that we have got some very significant level 3 assets, and we describe those. And indeed, the auditors, to be fair to them, described them in the audit report last year, now in the new expanded audit report that's been brought in. And the first thing they raised was our large portfolio of loans to the education, social housing in this country, because those are level 3, they don't trade, we have got them in at fair value. And the reaction I got from one investor on one occasion was, well, why are you bothering to describe that, because surely fair value is all about derivatives. To which I said, no, if you read our accounts, you'll see that we've got a variation on that one of about £1 billion, and it's the biggest number that we've got. So people do need to read the information that's there in order to start getting something out of it. And I do worry that there's this ever increasing demand for more and more information, to such an extent it's now got to be data rather than information. So I have to say we're looking at trying to, I think when you've dropped cutting clutter, haven't you? You've now moved on to something else, but concise and clear. We're trying to be slightly more concise this year and reduce the size of our annual report and accounts, because having introduced the new requirements that Sue alluded to around securitisations, we had 12 pages of notes on our securitisation activities, which actually, if you analyse it in detail, probably doesn't amount to a row of beans, but so we are looking to cut that down a bit this year, because I think there is a concern about just pushing more and more stuff out there. People don't read what's there.
Can we move on to the question of incurred loss and versus expected loss? It's one issue. Let's start with you, Vincent, on this one, because obviously there's been a lot of debate about this. And do you think that the problem with the incurred, I mean, Sue alluded to this earlier, but do you think the problem with the incurred loss model was with the rules themselves or with boards and investors? Do you think that the incurred loss model is a step forward for investors?
So the expected loss model. So I guess there's the issue of the timely recognition of losses, and one would anticipate that under the expected loss approach, there'd be a more timely recognition of losses. So projections, some early projections that have been done clearly indicates that that would be the case. So I think there are, I won't mention the source, but there's one report which has shown that one would expect the allowances to be up to 33% greater than they currently are. And the impact of that on the tangible book value would also be significant. And that in itself would address that price-to-book ratio play that's currently where the price-to-book ratio tends to be below 1. So once you've got a more aggressive impairment regime, that would certainly help redress that to some extent. I guess there's a question as to whether you'd have greater procyclicality as a result of the expected loss approach. And it's hard to say at this point in time. I think academic evidence, which does exist, does tend to show that the incurred loss approach is more procyclical than the expected loss approach. But there are different points of view on that particular aspect. But I guess from an investor standpoint, really the critical issue would be around the timeliness of recognition and hopefully the disclosures that would also be provided around the impairment approaches that are taken. There'd be an improvement in that regard relative to what we've had previously under IAS 39.
Yes, so Win.
Yeah, I do have a view on that. I think it ultimately will come down to what expected loss actually is. My view on expected loss is not that I can say with great certainty as a banker that a loan which I've made to a particular entity will in fact incur a loss of 20% or 30%. That is not the case. But that it is a judgment that I make that given the circumstances of the economy, given the circumstances of the company to which I've lent, all those aspects, that it is appropriate and prudent to make a provision against it, rather than that I have a 100% certainty that there is going to be a loss on it in future. And I would come back for this is a personal view rather than an FRC point. I think it would be very useful to have, in fact, a tabulation of incurred loss, and then for the investors to see what the expected loss is. To have the two being different, so that the investor can actually say to himself that if a bank Y has added, let's say, 0.3% of its loan portfolio to as a provision, and somebody else has done only 0.15, that either that particular bank that has done 0.3 has got a really lousy loan portfolio, or that the other bank that has only done 0.15 is being rather too optimistic about its future, something like that. So I think once you get that, you get a greater transparency, and from an investor's point of view, transparency is actually very important. It's a judgment call. I think bankers should be able to make a judgment call. Auditors should be, in fact, skeptical, express skepticism about, what judgment call is going to be made, and then a description of where the judgment actually is being exercised. Incurred loss, and then expected loss is the judgment call, but it should be delineated.
Sue, do you want to comment on that? Because I think that investors are being denied some important information here.
I think that the main improvement that comes from the expected credit loss model will be the richness of information that's available to investors. But building on the points that Hugh and Mike were making about sort of the depth of information and taking the time to look at it all, I think it's going to be very true of the expected credit loss model, because just looking at the number that's reported in P&L or the allowance balance on the balance sheet is really going to tell one tiny piece of the story. And as Wynne says, it's going to be very difficult to pick up the number and say, well, that means, on the face of it something, the message you can take from it on the face of it, you're not going to be able to get just looking at that number. You're really going to have to dig into the notes and see what assumptions there are behind those numbers and what's caused the changes in the allowance balances. And we've very much tried to introduce disclosure objectives to make people, or to encourage people to tell a story about why allowance balances have changed. Has it been because their expectations on existing loans have changed? Has it been because they've increased the amount of borrowing in particular sectors, to really explain that? And I think that's where there's going to be some real value add if people provide good disclosures. It's going to take quite a lot of education, I think, though, for the users of financial statements, because it's a very different way of looking at the world.
Mike, do you think these changes, the move to the expected loss model, will make will increase pro-cyclicality or decrease it?
I'm probably on the side of I think it has a tendency to increase, because it's probably more responsive to changes in market conditions, and markets always under or overshoot, and therefore you do tend to have, and it tends to be a spiral. So you start making lots of provisions, therefore people think the credit's bad, therefore credit becomes bad, and down the cycle you go. So I think it has the tendency to do that. I think that it will be, again, at the margin, so I don't worry unduly about it. I do think, though, that, I'll come back to Wynne's point, I think it is all, even with an incurred loss model, it is largely a question of judgment. and you can get good judgment and bad judgment. And I've seen a range of variation over the years in terms of how banks have applied the incurred loss model, whether it was under IFRS or the old UK GAAP. And I don't think you're going to see anything different, frankly, under the expected loss model. Indeed, unless we're careful, and I know people are spending an awful lot of time and the regulators are very focused on it, there is the capacity for even greater variation because there is much more judgment involved. And it's very difficult within the context of numbers to convey that sense of where you are on a spectrum. And I think that will be something that will evolve over time. People will start to gauge where banks are on that spectrum based on, and I was interested in Wynn's view that, you know, perhaps having some incurred loss information within the profile gives you a feel for how well people have been applying that expected loss model before they incur the loss.
Sue, and then Wynn.
I was just going to say something on the I get asked this a lot, this sort of pro-cyclicality question. I think what we're hoping that the new model does is appropriately reflects when there's changes in expectations. So if the market's cyclical, that should be reflected in the accounting. And I think the difference is that in the incurred loss model, and I don't think it was all about the incurred loss model, I think a lot of it was in the application, but the way that it got applied, you suddenly saw big shock effects in the financial statements that weren't really because something had changed fundamentally, but you just hit an arbitrary trigger that you'd been looking for. So it may have been a change that had been coming for a long time, and it came through the accounts as though there was suddenly this big change in the market when it was really just the cumulative effect of waiting for a trigger. So I think that we should, if it's applied properly again, get more timely information that properly reflects changes in expectations in the market, which is true information. But I think the other piece of the puzzle, which is really important, is going to be how it links in with the bank's prudential and regulatory requirements in terms of what they do with the expected loss model and what they then do as a consequence in terms of setting the capital requirements for banks, because that's in the banking market, you know, what really matters at the end of the day, I think.
Yes, it's an important topic. I want to come back to Wynn. Did you want to?
Two things. One is, as Sue has just mentioned, and of course, in stress testing, the regulator tends to take a view in relation to expected loss. I mean, either expected loss or stress loss or whatever it is. So should the investor, in fact, have at least a bit more information along similar lines? The second thing is there's a social aspect to it, that if effectively on an incurred loss basis, even though the judgment may be that the economy is turning down, etc., the profitability looks to be, in retrospect, overstated. You're paying incentive compensation off that higher profitability. I think, as has been seen, the incentive compensation has made in the public mind a great deal of has caused a great deal of harm to banks in the way that they have been perceived. And I think it's, in my view, from a purely social point of view, I think if the profitability of banks, which ultimately determines incentive compensation to its people, is in fact reduced at a certain level, at a level where most of us as bankers would have thought it's cyclically high, that's not a bad thing.
So, Vincent, so I'm instinctively very, the regulator's been pushing hard for this change, and that makes me instinctively suspicious. So Wynn says that there's a social case for this change of the rules, but from investors' point of view, I mean, do you want your accounts contaminated by regulatory, political, and social considerations, or do you think that they still contain that it's still useful?
I don't think there'd be that much appetite for those other considerations. But the one point I wanted to mention, because I think Sir Wynn mentioned that it would be beneficial to give both views, the incurred loss and expected loss perspective of different institutions to investors, and I would concur with that. But there's a third data point as well, that the fair value disclosures that are provided. Interestingly enough, I think a month ago, the Bank of England did issue a paper in that regard about the quality of disclosures that you do get on the fair values of the loans. And what was interesting, when you look at UK banks, there was a 55 billion valuation gap between the carrying value and the fair value. And this gap has been sustained for quite a while. And I think it's important for investors to be able to also understand where these valuation gaps do arise, especially in the context of the significant fixed rate exposures that do tend to exist. So when you look at the mortgage book of banks across the board, you've got up to 65% being fixed rate exposures. So it's important to have some greater color as to why the differences between the recognized amount, which would be the expected loss. For the expected loss approach, you're using the original interest rate, whereas for a fair value, there'd be a revised, updated interest rate, which would be applied as the input. But there'd also be other factors in the assumptions that management is making around prepayments, the recoverability of cash flows. So that number currently exists, but there isn't much color around why there are differences. So it would certainly benefit investors if there's clarity around those three perspectives, the incurred loss, expected loss, and the fair value, which is currently required. I'm aware that there would be a concern about the bludgeoning of disclosures, but that's a separate point for discussion as to how you can make the overall package of disclosures more effective. But I just wanted to highlight that aspect of the fair value disclosures being important as well for investors.
Come back to you a second, Mike, as well. Bring you in. Could you also one thing maybe you could also just address was, is that the US has taken a slightly different approach on all this. Maybe you could just give your thoughts on whether what's wrong with their approach, or whether maybe we should be converging to it. Why their approach is different, maybe.
Yeah, obviously it's unhelpful that we have different approaches. I think the US approach, which is recognising full lifetime expected losses up front, is not something that the ISB felt able to support for obvious reasons, I guess. I guess on this subject, I wanted to echo very much what Sue said. I think this is a lot about richness of disclosure, though, when it comes to implementing our model. But also just to make a general point and perhaps wave a flag a bit, because we've touched on it a few points. And this is the whole burden of disclosure that preparers do have. You know, Douglas Flint of HSBC used to go around saying that his accounts had become so heavy that they couldn't by law be delivered by UK Post. So heavy had they become. We have a disclosure initiative as one of our projects at the ISB at the moment, and it's all about effectiveness of disclosure, and trying to find ways for preparers to deliver their messages perhaps more concisely, but not necessarily just about the conciseness of information. It's about delivering it in an effective and meaningful way, rather than a way that it gets lost in a great swathe of information that one does find in accounts these days. So I think this point about effective communication of disclosure is one that really resonates with people. It's very important to us, which is why we're working on it. And I think it is part of the solution to all of this.
Mike, you wanted to comment?
Yeah, I was just going to pick up on a couple of points that Vincent made. I do think that the idea of thinking about how better to explain what's causing some of the differences, particularly with fair value, where you've got a muddling of both interest rate components and also potentially impairment type considerations, is not necessarily very helpful at the moment, particularly since you tend to get the information at the level of loans and advances, not split down in any great detail. So that's certainly a thought worth thinking about. But it also put me in mind that one of the criticisms, I suppose, and so it won't come as a surprise to you because you and I have had this conversation before, one of the criticisms I've had of both the incurred loss model and indeed the expected loss model is the fact that they both rely on the original loan interest rate in order to discount future cash flows. And therefore, it's not when you're in an impaired situation, and therefore the element of risk that you are invariably taking as a bank is higher than when you originally granted the loan, you're applying an interest rate which is not necessarily appropriate for the cash flows that you're modelling. And it's slightly difficult to see how people deal with that. And therefore, in terms of coming back to your point, Sue, on shocks, it's still one of the areas where I think you see shocks, because if a bank changes its attitude to a particular loan from a hold it, see it through, particularly at something like a development loan, to let's flog it, then the chances are they will take a big hit at that point in time, because the let's flog it position will be using a discount rate that a new investor coming into that with all the riskiness of the cash flows of land development potential, etc., is going to apply, not the loan original interest rate, and that can be quite different. Quite a difference.
Could I ask a question to Mike? Mike, do you think it would be helpful if a bank and its audit committee actually, or risk committee, actually looked at the ability to repay rather than looking, because that would in fact encompass also the future interest rate, or the interest rate that it might in fact be attached if it were a new loan, or do you think that that would just make it more complicated?
I think, I don't know whether it's the ability to repay or whether it's just marrying the interest rates and the cash flows in terms of you apply an appropriate discount rate to the cash flows that you're modelling.
Which would be different from...
Which would potentially be different.
Yeah.
And you can either do it by being very cautious on the cash flows that you model, or you can change the discount rate. I suppose because the standard currently prescribes the discount rate,
That's right.
I encourage people to be cautious on the cash flows.
Well, yeah, I think you should use cash flows that are reflective of the discount rate you're going to apply. But, yeah.
Well, you're meant to use best estimate cash flows, and the trouble is the best estimate may not necessarily be the...
But, Professor,
Anyway,
but for
we can have this debate some other time.
Right. I think let's move on to a different topic, which also has been raised, which was came up during the crisis, which was the issue of off-balance sheet accounting. Was this, Sue, was this a problem for IFRS or for the world?
For the world, yes. I don't think so much for IFRS, thankfully. Because we took very much a risk and reward based approach at the time, I think that most or a lot of securitization transactions that would have been off balance sheet in the US were actually on balance sheet in the IFRS world. So I think we had far less surprises on that. And really all that we did was, as I said, tidying up disclosures to make it a more full set of disclosures, and made some changes to consolidation, but not dramatic ones. So I think that was where we had less of a problem than in other parts of the world because of our accounting regime. And maybe also because there wasn't as much securitization in our part of the world as there was in the US as well. So sort of economic factors play into it as well.
Wid, you had pretty direct experience of this particular issue. Do you think that this has been resolved, or whether?
Well, from a practical point of view, when one looks back at 2007, 2008, 2009, of course, you had special investment vehicles, for example, in which banks had a very small stake, but where in the fullness of time, for reputational and other reasons, they bailed out those vehicles. Was that reflected? No, it was not reflected in the accounts at the time. Should there have been more skepticism, whether by the auditors or whether by the bank managements themselves, that if the special investment vehicle actually went down or lost a great deal of value, even though your own exposure was limited to, let's say, 5 or 10%, for all kinds of reasons, the banks bailed out that investment vehicle. Now that is not reflected basically in accounting terms. Should it have been reflected in risk, in the way that people looked at the risk? Should people have been more prudent in relation to that? Yes, I would have thought. That is with the benefit of hindsight. I suspect, actually, the way that the Americans looked at it was much more legalistically, as Sue has just said, and mathematical, yeah.
Vincent, what do you feel from the CFA Institute's point of view? Do you feel that the off-balance sheet issue is adequately dealt with?
There were issues, certainly, but it's early days because we've had IFRS 12 and IFRS 10, which has just come out. But I think the points have been mentioned around where you had continuing involvement, and to the extent that investors were always fully aware of the exposures that existed in that regard. I mean, there are lots of cases one could cite where clearly investors weren't aware of the full range of exposures that came into play when reputational risk was at hand, and the banks then had to take on board the exposures that they had. There'd also be issues around the retained interest and how that was being valued previously, and you do not necessarily have a fair value view of that retained interest. I think the indications are that what's been done under IFRS 10 and IFRS 12 will fix whatever problems may have existed. But I would just say it's early days. You really need a couple of financial statements before you do get comfort that in the long run that's a problem that's been fixed.
Mm. What do you think, Mike?
I certainly think the disclosures help. And I do think it's back to this question of judgment. The main bank I dealt with as an auditor at the time of the crisis only had one significant sieve. they felt that the way they had set it up, the investors they had in it were wholly cognizant of the risk, etc., and they didn't bail it out. They took a very conscious decision they weren't going to. So it would have been wrong to account for it as if they were going to. So it's again, it's a question of judgment.
I think a bigger challenge now with that is something which Mike alluded to earlier, which is the fact that I think it's challenging now for banks with lots of structured entities to make sure they can get meaningful disclosures across to users of financial statements about the risk exposures they do have to all of these myriad range of entities in a way that's both meaningful but digestible. And I think that's something where hopefully we'll see practice develop over the next few years as IFRS 12 gets underway.
Everyone's learning.
Yeah.
Any thoughts?
I would just make the point, I think that the relevant guidance at the time, IS 27 and SIC 12 for special purpose entities, I think that guidance held up pretty well, actually. And you really find that many IFRS reporting entities, as was just said by Mike. There weren't that many bringing on really material entities onto the balance sheet as a result of supposed defects. I think there is something about disclosure and trying to understand what would happen if certain, if backup liquidity facilities suddenly kicked in and the bank was on the hook for losses all of a sudden. There is something about disclosure, but I think in the main, the relevant guidance held up pretty well. So I think that the standards that we now have are an improvement, but I don't think that they were improving something that was broken in the first place.
So, Mike, as the chairman of an audit committee tasked with providing transparent, useful information to investors in Barclays, do you think that the IFRS the ISB has now addressed all the problems that emerged in the crisis, and that the accounting regime is now fit for purpose?
You're not going to get me to give that hostage to fortune away, I have to say, because I've no idea what the next financial crisis is. If I did, I would perhaps be trying to do more about it.
Well, have they resolved the problems that emerged from the last crisis now?
I think to a large extent. I mean, I do, as I said, I do think there's an element of pro-cyclicality still, and inevitably, in my view, an element of pro-cyclicality in accounting, and I don't think that's a bad thing. It tends to follow markets. The trouble is, it does tend to have the effect of reinforcing the spiral that you get when markets either go down or go up. And I think certainly there are those on the Financial Stability Board and some of the bank regulators who would be keener to use accounting to smooth out those imperfections. My personal view is I don't think that would be doing investors any great favours, so I'm not in favour of that. One reason why I dislike the FASB model for impairment, because I think actually you get less information about what's actually going on if you've tucked it all away on day one. So I think that it's gone a long way. I think it's not just, though, IFRS, it is the other things that Vincent mentioned, the EDTF, and an awful lot around disclosure, because everyone needs to play a part in anticipating what's going to happen next. And accounting is really about where we are today. As I said before, with the best will in the world, accounting is about where we are today, with a little glimpse into the future, but it's not there to predict major economic cataclysms.
What do you think, Win? And also, I'm particularly interested in your idea that, you make the point that one of the side effects of the accounting as it was before was to inflate profits in a sort of pro-cyclical way. And but is it right that the accounting regime should have to make up for the sort of the incontinence of bank boards in distributing all the profits in an imprudent way?
Simple answer, no. Should not. I think there is a philosophical question, and I think it goes back to something that was said right at the start. What does auditing and what does accounting actually do? And I think a lot of the discussion that takes place is actually something which derives from the fact that audit and risk were, in fact, were considered to be all the same. I think in financial institutions there's a big difference. Audit and accounting actually deals on the whole, with the past, and perhaps does not have as much judgment involved, or does not allow as much judgment because of the way it has been set out. Risk, I think, is something else, and I think if one looks at where the responsibilities lie. I mean, I do believe that there are some aspects in relation to accounting which may have contributed, but ultimately it's judgment and risk. And the Risk Policy Committee, the Risk Committee of banks, the Risk Committee of insurance companies has a great deal. In fact, they take the forward look. They should be looking forward far more than perhaps auditing. We shouldn't perhaps get ourselves too much involved that auditors, they should be skeptical. But should they actually be looking too much forward, and should the accounting standards, in fact, look too much forward, will that, in fact, deflect ultimately from the exactitude which we expect? That actually also means that there has to be far greater education aspect to it, because the public at large does actually think that audit certifies, guarantees the solvency of the company and so on. It does it at a point in time, 31st December, 31st March, whatever it is, but it's the risk side of it, and the board of directors as a whole that must be responsible for the future.
Hugh, do you agree? Do you think that accounting's gone about as far as it can now in terms of addressing some of the failings of the crisis?
I should expect me to answer yes to that question. Certainly at the time that IFRS 9 was published, we said that it completes the improvements that the ISB is going to make in this area. I think there is some work to be done, though, and I think one should acknowledge as well when talking about this that it's unfortunate that we were not able to achieve convergence with the FASB on financial instruments, and therefore one of the things that we have to work hard on is a consistent application of what we do have. And as probably most people in this room know, we have a transition resource group specifically set up for impairment, which is one of the areas where there's going to be the most judgment in applying IFRS 9. And there are regulators who are obviously, and not surprisingly, very interested in consistent application as well. So I think we have some work to do to make sure that the implementation piece is done in the best possible way. And of course, we shouldn't forget it's 2018 is the effective date for IFRS 9, so there is some work still to be done. And meanwhile, the Financial Stability Board have made clear they want us somehow to be working with the US. I think it is in terms of consistent application. But if you're, as an analyst trying to look at all these different banks, one's on US GAAP, one's on IFRS, it is quite hard. There are some very large differences between balance sheets, and because we have different guidance, it does take a lot of work to figure out what's going on, and we still therefore do need to work on that.
Sue, is that the big failure of the accounting post-crisis response, the failure to converge?
I guess, yes. I went back and looked at the Financial Crisis Advisory Group report in preparation for this panel, and convergence was a very strong message that we got there as one of the desired consequences of our response to the financial crisis. So I guess we've done all the stuff we could do solo, but we couldn't achieve convergence. And that's certainly unfortunate. But we responded to our due process, we responded to our stakeholders. The FASB did likewise. It's difficult when you've got two independent boards who are tasked with a role for two different sets of stakeholders. Hans always uses the analogy of imagine if you had two Basel committees, how difficult that would be, and I think that's a good analogy. So we did as much as we could, and ultimately the message that we got from many, including the Financial Stability Board, was it was more important that we move forward on a timely basis to improve IFRS than to spend more years of trying to get to a common solution when our different opinions were so entrenched.
Some might say that we do have two Basel committees, or at least one of the most important jurisdictions in the world just decided to ignore it. But Vincent, does anything still keep you awake at night in terms of accounting? What are the areas that you think are unresolved?
First of all, I would echo what the rest of the panel has said. Convergence was a missed opportunity. But it's also worth saying there have been some relative wins. So when you look at offsetting, the disclosures that have been enhanced to allow comparability is certainly something that investors do welcome. The ideal would have been for both boards to have converged with the offsetting requirements, but the disclosures certainly do help. When you look at IFRS 9, there are three strands to it. We've talked extensively about impairments. When you look at hedge accounting, one would say that investors are looking out for the kind of disclosures that would inform on risk management in complement to the actual model, which allows hedge accounting to occur more expansively. On the classification and measurement, when the ISB undertook the IFRS 9 update, I think there had been an expectation that there would have been reduced complexity. Whether that's been achieved, I guess, would be a question to put on the table, because it still seems to be a relatively complex model compared to what was there with IAS 39. So the impairments, one would give a tick for that. Hedge accounting, there's a wait and see. Classification and measurement, it's hard to say whether complexity has really been reduced as a result of IFRS 9.
Yes. Hedge accounting was one of the options in that last question which we had. And this is the last question before I think we should throw it to the audience for questions. But very briefly, I'm just interested in what the panel thinks in terms of that last question. Where might the next accounting scandal come from? Mike, what's your crystal ball? Where do you think? Where would you be most anxious?
In terms of the four you put up, I'm probably with the majority on public sector accounting, which is unfortunate given one of my other roles is I'm a member of Her Majesty's Treasury's Audit Committee. But it's interesting and it's not a defect necessarily of the accounting, it's a people not realising the impact. I think one of the things the UK government's done recently, which I very much commend people to look at if they want to keep themselves awake at night, is a thing called whole of government accounts, which is actually quite interesting, where they do bring all of the public sector together in perhaps a more meaningful fashion than you see some of the statistics that get produced by government. And that'll tell you that basically everything in this country is funded by promises to future public sector pensioners.
Yes,
until we fix that, we ain't going to fix public sector finances.
Moderated a panel in Athens last week on Greek economy, and there was a fascinating speaker who's just written a book on the history of accounting, or it's a history book about accounting, an American academic, and his thesis is that basically successful societies are those that properly account for their public sectors, their government's accounts, and that when governments cease to account for their own activities, that's when countries fail. So anyway, that's Jacob's soul, I could suggest. A very, very good man. Where's the next accounting scandal coming from you?
I do strongly agree that the public sector is a place to look. Whether it's the next one is an interesting one, actually, because the timelines are very long. And certainly if one's thinking about pension commitments, is it the next one, or is it somewhere further down the track?
After insurance.
Well, we're working on insurance, so we'll see where we go. It is interesting that if one tries to figure out what the government's finances would look like, were they to apply something like IFRS, you can quickly on a whiteboard get some very, very large numbers. So there's no question that at some point we will run into something. Whether it's the next one is interesting or difficult to tell, but there's definitely there is definitely something in it. I just got to come back to one thing on what Vincent was saying in terms of complexity and our current model. So I'm going back in the conversation here. I do think one point that's important to make is that IFRS 9 is a much more principles-based standard than its predecessor. David Tweedy used to say that if you've read IAS 39 and understood it, you haven't read it properly. And we very much hope that IFRS 9 is not in that camp. And I think it is much more principles-based, and therefore one should be able to make more common sense of it, which I think is important.
Sue, next financial crisis, next accounting scandal. What keeps you awake at night?
Well, I'm always conscious of the fact we're always solving for the last set of problems that we became aware of, rather than being very good at guessing what the next set are. I think it's hard to predict. Public sector accounting is probably one. I think that one that we're, of course, very focused on is making sure that there's enough transparency about risks in the insurance industry. So that's one that's probably front of mind for me as an area that we certainly want to, I don't know if it's the next crisis, but we want to improve transparency to try and make sure everybody at least knows what the risks are there to manage.
When Lloyd's has a giant insurer embedded in it, did you feel that you were getting an adequate sense of the risk in that business from the accounts you were receiving?
Obviously, there are two areas of insurance. Life insurance is particularly difficult from an accounting point of view, and that's not easy to understand. I remember being on the board of the PRU, and it really, you know, there's so many different ways actually of looking at what a life insurance company's surplus or profits are, and to what extent they're realized, to what extent there's cash flow, and life insurance companies only seem to turn into really good cash flow machines once they, in effect, start reducing rather than growing. You know, so there are difficulties. I think we had a reasonable understanding, obviously, of the business, but it is complex, and it differs from bank accounting. The risks, I didn't think, if we had a view as to what the next financial crisis might be, you know, that's a difficult thing to think of. What I think of as risks are in public sector accounting, particularly pensions. And I don't think that's just in this country. If you think of China, which has got an enormous public sector operating in what might be called a private sector, broadly private sector economy, I think that's a big risk, I think, which we haven't taken into account, which might have all kinds of secondary effects in the rest of the world. And then insurance, I think insurance companies are well run. One of the real difficulties will be that to the extent that insurance companies may be forced more and more to take a view of not investing in risky assets, equities. I think there's a real risk that by being forced down to invest only in fixed income securities, that the whole life insurance sector, forward-looking, long-term thinking of life insurance will become changed, and I think that's a risk for a business model.
Well, look, thank you very much to the panel. I think at this point we've still got 25 minutes, so we can go to questions from the audience. So can I see a show of hands? So we've got someone at the back here. Any?
Hi.
Just say who you are. And
Mark Rees from Deloitte. I think a number of you know that. One of the things you didn't mention was risk-weighted assets. The investor in a bank balance sheet is worrying about whether they need more capital, and that capital is driven by the regulatory balance sheet rather than the accounting balance sheet. And those risk-weighted assets is a disconnect that the reader of the accounts has no external audit evidence and little accounting or reporting framework about it. I wonder if that was something that would prompt a discussion amongst you.
Interesting challenge, Mike.
Yeah, I mean, there's obviously quite a lot of information around risk-weighted assets, both in the front half of most banks' report and accounts, and obviously the Pillar 3 information. Yes, it's not audited. Have I heard a demand from investors that it should be audited? Not really. If there was, then we would no doubt think about whether voluntarily we went down that road. It's interesting because, of course, in the past that was probably played a greater role than some of the other regulatory constraints. I mean, leverage is almost as big a constraint these days as RWAs. And indeed, RWAs themselves the regulators are just in certain areas discarding banks' own models and forcing their own views on life, many of which, frankly, I'm not sure are terribly well thought through, but are all designed to just increase the amount of capital you hold. It would probably be easier just to say you need more capital and just increase it, but they do go through this regime of flexing the RWA models as well. So I don't know how much RWAs is going to play a role in the future.
I think it might be an area where there's a confidence question, certainly, that I've heard from investors in terms of how solid are those numbers, given the increased awareness about how diverse those numbers might be for the same assets between banks. But I think that the approach that Basel, thankfully this isn't our problem for once. In terms of Basel, my understanding is that's one of the reasons why they're looking at their sort of enhanced Pillar 3 disclosures, to try and use that as a mechanism to provide a bit more comfort to investors. And one thing I think which I have got questions on is sort of investor confusion about understanding the difference in the regulatory balance sheet perspective versus the accounting balance sheet perspective. And I was interested to see that in the proposals for the Pillar 3 enhancements, that they were proposing a reconciliation from the accounting numbers across to the reg capital risk-weighted assets. And
yeah, we try and do that. It's easier said than
yeah,
done,
I'm sure
particularly when the regulators insist we consolidate things that you don't.
I did look at that and raise my eyebrows because it didn't look like it was going to be very easy to me, but I'll be interested to see what feedback they got and whether that happens, because I think that would help investors get comfortable that they understand the difference in the two bases, which is where questions arise.
Vincent, do you have a concern about the regulatory risk-weighted assets and the auditing of them?
I think the comments have captured the main concerns around comparability of the numbers and the need for assurance of those numbers. Though Mike seems to have the view that that's not really plausible. But I think
sorry, in terms of providing assurance, yes, but I've just not really heard the demand from investors hitherto.
Yes, certainly that would help, having some level of assurance around the numbers. And the disclosure, the reconciliation of the financial statements with the regulatory balance sheet, that would certainly help. And a couple of ADTF disclosures as well, the flow statements that are required, which do help as well in terms of understanding the risk-weighted assets. But it's clearly a point of concern for investors, the comparability of the numbers that you get. But there's nothing more I can really add over and above what's been said.
Do you want to come in?
Well, just to echo, I think what has already been said. You know, the BIS did a study relatively recently which looked at different banks which had model approvals for different business lines, and tried to figure out if you could somehow reconcile the capital that they were holding as a consequence of applying these models, and found it very hard to do. There is quite a large range, and I think partly because of that, and you know, regulators now are more interested in things like the outright size of the accounting balance sheet, and also leverage, and most regulatory calculations of leverage, if they're not exactly the accounting numbers, they are certainly very strongly driven and might have some adjustments for things like derivative netting. But essentially, you're looking at the accounting numbers when you look at leverage. So I think the regulators have picked up some of these apparent anomalies and are moving away. I think there's less appetite now in the regulatory world for model approvals, and perhaps regulators want to move more to a standard rules way of figuring out what capital should be held against different business lines.
Any more questions from the... Yes, question over here. Are there any other questions? We might take a couple at once if there's anybody else who wants to ask one. Okay, you have time to think. Right.
Andrew Spooner from Deloitte. I just wonder whether the panel thought, what was the bigger impediment to comparability for impairment under the expected loss model, whether it was the difference between US GAAP and IFRS, or whether it's to do with the view that prudential supervisors will take at a national level when looking at impairment numbers. I mention this particularly in the context of the AQR in the European monetary area. Obviously, they've taken looking at the strength of bank balance sheets. I just wonder how much you think that the national supervisors will impact the application of expected loss model.
I'm certainly hoping it's going to be the former, but I understand your question. I think the former is going to be a challenge. We haven't seen the FASB's final words yet, but I'm not sure, even when you get to lifetime expected credit losses, whether their words are going to mirror our words in terms of how the calculations work. So I think that's going to be a challenge, even without even setting aside the different measurement objectives that we have in the standard. On the second question, the comparability of the IFRS numbers, it's a good question and obviously a very topical one following the AQR and the actions of the ECB there. Firstly, I think that we have to get it's a different model, the expected credit loss model, which is very much hinged on management's expectations. So I think we're thinking about comparability in a different sense anyway. I don't think we'll ever get to a situation where you can just, pick up the accounts of Barclays and HSBC and compare them as like to like. You'll have to dig into the assumptions, which could validly be different because management have a different expectation for some valid reason. But setting that aside, we're trying to work as closely as we can with the Basel Committee, with the work that they're doing on their view of the good application of IFRS 9 on impairment, and I know that's causing a lot of anxiety in the market with the banks in terms of what they might come and do that overlays or overrides IFRS 9. We hope they won't do that, but the reason why I personally am very supportive of Basel taking those actions is I'd much rather word was coming on high from Basel in terms of how to apply the IFRS 9 impairment requirements than having national regulators in every jurisdiction doing something slightly different. And so we're trying to do as much as we can to encourage it to be a global application. And I must say that everybody's worried about comparability of IFRS 9, but probably one of the most surprising things for me when we dug into impairment and looked at what was happening on IAS 39 was the lack of comparability in the application of the incurred loss model, which we all talk about as though, there's not that much judgment, but believe me, the jurisdictional differences there were quite surprising.
Mike, who would you prefer to have interpret IFRS 9 for you, the Basel Committee or the Bank of England?
Well, the answer is I don't think it's a question of preference, because I think they're both going to, because Basel will set a baseline and every national regulator will seek to improve and increase the baseline. That's reality, I'm afraid. I'm not totally do I think it helps investors by improving some level of comparability? Potentially, yes, but it'll be rules. It won't be coming back to people using judgment and articulating what that judgment is, and I'm not sure that is a good thing. So I'm not keen on over-prescription of how you apply it. But I would certainly echo Sue's point that it's not even just national regulators, it's the national environment and the national psyche dictates how people apply IFRS, I'm afraid. And the more judgment there is in the context of that particular standard, the more the national attitudes come to the fore. So when you apply the incurred loss model, if you think about the countries, particularly around Europe, that applied it, they all came from their existing national gap, and that played a big part in how they applied it. If I contrast just simply the UK and Germany, for example, UK, I think, had a largely incurred loss model with judgment before, and IAS 39 was not particularly different, and therefore those good banks still applied an element of judgment and were sensible about how they applied IAS 39. I think in Germany, where they'd gone to the other extreme of actually hidden reserves for very many years, when those were just outlawed, they didn't then seek to supplement it by being judgmental about how they applied the loan loss provision. So almost, actually, they went from one extreme to the other.
Yes.
But I think it's inevitable, to be honest.
These cultural national differences become clearly more important the more one digs deep in European finance. Wynne, you wanted to come in?
Yeah, on comparability, of course, there's also the comparability in relation to, let's say, 100% owned UK subsidiary of a major American bank. The UK is a very large financial centre for American banks, and the comparability as to whether how you, in fact, look at the Inc., the US holding company, and its consolidation as against some aspects which the PRA may, in fact, impose, brings with it its own difficulties. It isn't just Europe, it isn't just Basel, it's between these two regulators, the OCC and the Fed, and the PRA.
Do you want to add anything?
I would just maybe briefly mention that I think the securities regulators would also potentially have a role. So ESMA in the past has tended to monitor financial reporting and point to areas where there are inconsistencies. And the feedback they've tended to give has been quite helpful in making investors aware as to where there are differential judgments occurring. So for example, in 2013, they had a review of the reporting of financial institutions in 2012. And they really pointed out to various areas where there are inconsistencies in application. And I think that needs to be ongoing to help investors really understand how any new model is effectively being implemented. So to augment the efforts by the prudential regulators and the Bank of England here in the UK, I think the securities regulator role would also be very important.
And that's why we've got both IOSCO and representatives of the Basel Accounting Expert Group on our impairment transition group, because we really want to try and encourage consistent application right from the start of IFRS 9's life. It's a fair point.
That was the point I was going to make.
Sorry.
Right. Okay.
The transition resource group is obviously a really important part of it for consistent application.
Any more questions from? Yes.
The panel's mentioned the challenge of explaining complex business models in banking, and it's possibly even greater in insurance. There are a number of initiatives such as the EDTF work and market consistent embedded values in insurance, sometimes described as market inconsistent embedded values, which try to address this challenge. But how far should the ISB be trying to look at some of these challenges when it's trying to set standards across all sectors, and how far should we encourage other industry-led particular initiatives such as EDTF, etc.?
Who wants to pick that up?
Well, I could talk about the EDTF because I've had relatively close involvement with them, and actually Vincent's on it. But I think that there's a role for us both. We're just one piece of the puzzle along with many other participants in this whole exercise to try and get good financial reporting. And I see our role as being very much complementary with bodies such as the EDTF. We, as you rightly point out, set standards that aren't industry specific, rather topic related. The EDTF has the benefit of being able to focus on the user information needs for a particular industry, so they can be more focused. But where I think the EDTF has done a good job is really where, for example, if you look at IFRS 7, we've got very principles-based disclosures or objectives-based disclosures. A lot of their specific requirements where they've come along and set in place templates and more specific disclosure objectives, they very much tie in with the general themes that are in IFRS but build on them and make them more specific. And it's where I think comparability comes in, because I think it's much more appropriate and easier for a body like the EDTF with an industry focus, and particularly focusing on large banks globally, to come in and put in place some more specific disclosure requirements to meet particular user needs than for us to be so specific and template-based and prescriptive in our requirements, which have to be applied across a really broad range of industries and also different complexities of institutions. So I don't personally see them as any sort of threat, or that we should be doing what they're doing. I think their role is complementary because they can be industry specific, and also because they don't have the due process requirements that we do. It's much easier for them in case of need, if there were, God forbid, another financial crisis, to be very responsive and very reactive to convene and come up with a set of specific disclosure requirements to meet a very particular information need. Whereas for us, it can take quite a while because of our exposure and due process requirements. So I see it as complementary.
Vincent?
Yeah, I'll just concur with everything you've said. It's really a complementary. The EDTF work was really complementary to what the standard setters are trying to achieve. And one of its appeal actually was also having that direct dialogue between investors and the banks themselves. And clearly, there's a model that could be applied on a more broad basis, having that direct dialogue and on a very contemporaneous and timely basis, addressing issues that matter today and trying to come up with solutions that can be enacted immediately. There's also an aspect of anticipating the emerging risk areas that the EDTF endeavors to undertake, which also makes the work that they do a lot more relevant. So it's certainly a template that could be extended and applied perhaps by other industry bodies as well, to try and foster that dialogue between the users of financial statements and those who prepare the financial statements, and then just feed that into the standard setting process as and when required, I guess.
Do you have a practitioner view on this, Mike?
Yeah, I would have said it is largely complementary, although I was slightly amused when Sue described IFRS 7 as a principle-based standard, because it starts off quite well, but actually it does have quite a few prescriptive disclosures in there. And I suppose the one thing I would encourage you to do, if that's the model for the future, is cut down even more on the prescriptive stuff, because if I look at the credit risk section of the Barclays accounts, a draft of which for next year I've got wandering around in my briefcase, that it's actually quite difficult to make it concise and bring it all together, because you invariably are putting in a large number of tables which are being driven from different requirements to show slightly different cuts of the same data, and it's actually quite difficult to put it together in a sensible, cohesive fashion. So the more about that. I was also interested in Vincent's suggestion that the EDTF might be a model used by other industries. I look forward to the day when the insurance industry picks that one up.
So where do you want to go?
I'd like to look at it from a more macro point of view. I agree with the points that have been made in relation to some of the specifics, but I think what we need to get across, what the industry needs to get across, is what auditing and accounting standards actually do, and what, in fact, the opinions of the auditors and the audit committee actually means, rather than, because I think the details of it, while very important for practitioners and for preparers, are not so important for the media and for the public at large as to what it actually is all about. So I'd look at it from 2 points of view. One is, can one get a message across what it actually means and what it actually is designed to do? And then secondly, of course, for those who are more practitioners or nerdy, really the comparability in relation to certain standards and so on, which is important for a quite different audience.
I think we have just time for one more question, if it's a quick one. A show of no hands I'll take as a sign people want to have coffee. Right. Okay. Well, I think at that note, I think we'll end the panel there. I want to thank our very eminent panel for their answers. So Wim Bischoff, Sue Lloyd, Hugh and Mike and Vincent for a very informative panel. Thank you very much indeed for listening.